Have you ever wondered why the stock market suddenly drops or skyrockets after the release of CPI data? Is it just a number, or does it have a direct impact on your investments? Understanding the CPI, or Consumer Price Index, is crucial for every investor, trader, and even common consumers. In today's video, we will break down how CPI data affects the market, what traders should look for, and how you can take advantage of it. Stay with me till the end, because this information can change the way you invest. What is CPI and why T matters? TI, or Consumer Price Index, is a key economic indicator that measures inflation by tracking the average price change of goods and services over time. It tells us how expensive life is getting. But why does the market care about CPI so much? When CPI rises, it signals inflation is increasing. High inflation means the purchasing power of money decreases, which can lead to higher interest rates. On the other hand, if CPI is lower than expected, it might indicate slow economic growth or even deflation. Investors, traders, and policymakers keep a close eye on CPI data to predict market movements. How CPI data impacts stock market? So, how does CPI data shake up the stock market? Well, it mainly influences three areas. Stock prices. When CPI is higher than expected, the Federal Reserve might raise interest rates to control inflation. This causes stocks, especially growth stocks, to drop. Investor sentiment. High CPI data creates fear in the market. Traders worrying that rising prices will reduce corporate profits, leading to sell-offs. Sector performance. Certain sectors, like energy and commodities, benefit from high inflation, while tech and growth stocks suffer due to higher borrowing costs. For example, in past CPI releases, we've seen major indices like the S&P 500 and Nasdaq react strongly. So, as an investor, knowing how to interpret CPI data can give you a huge advantage. Impact on Forex and crypto markets. CPI doesn't just affect stocks, it plays a major role in Forex and cryptocurrency markets too. Forex traders. Higher than expected CPI can strengthen the US dollar because traders anticipate interest rate hikes. A strong USD often weakens other currencies. Crypto market. Inflation concerns sometimes drive investors toward Bitcoin and other digital assets as a hedge. However, a high CPI also signals potential interest rate hikes, which can hurt risk assets like crypto. So whether you're into stocks, Forex, or crypto, CPI data should always be on your radar. How to trade CPI releases now. The big question: how do you trade CPI reports effectively? Check market expectations. Before CPI is released, analysts already have predictions. If actual data is higher than expected, markets react negatively. If lower, markets tend to rally. Watch interest rate hints. Federal Reserve statements following CPI reports are crucial. If they signal rate hikes, be cautious with high-growth stocks. Use risk management. CPI releases can cause volatility, so always set stop losses and avoid over-leveraging. Should you worry about CPI? CPI is important, but should you panic every time it's released? Not necessarily. Inflation is a normal part of economic cycles. Smart investors don't react emotionally, but instead adapt their strategies. If you understand CPI trends, you can make informed investment decisions instead of falling into market hype. If you found this video helpful, make sure to hit the like button and subscribe to the Profit Path for more insightful financial content. Also, let me know in the comments, how do you react to CPI data? Do you trade based on it? Let's discuss.